Gosh, you definitely caught my interest here because this sounds amazing. I'm going to definitely research this more after, and I'm sure we're going to have some conversations after this recording here.
I'm curious about capital, right? And maybe even the biggest frustration with the 1031 exchange, like you mentioned, equity versus debt. And a 1031 exchange is a continuity strategy where you have to trade ownership for ownership. In other words, equity for another equity placement. And it doesn't let you get on that debt side of things. But talk about the ability if someone could sell a business or real estate or crypto and exit multiple millions of dollars and then still defer the tax to be able to invest passively into like a debt instrument that has some liquidity built in and has much less risk than a lot of these deals that people have been overpaying for the last couple of years. What would that mean for a group like yourself that's been in the business for 15 years?
Oh my gosh, Brett, this is such a challenging and interesting question. I've been trying to crack this nut for at least a decade. So the 1031 obviously is super powerful. One of the reasons a lot of investors like investing in real estate, right? The problem is, as you mentioned, it has to be a like-kind exchange, and going from equity to debt isn't that. So we haven't been able to figure out how to defer taxes when you exit one investment into a debt fund. So I don't have an answer, but I would love to know your opinion on how somebody would be able to do that.
Yeah, you want to break it down right now? We can go into to building mode here with strategy. It's called building a capital gains tax exit plan. If people want to get started, you can go to capitalgainstaxsolutions.com. So this is how it works. Step number one, Kevin, you don't use a 1031 exchange, right? Because the first thing is 1031 exchange only works for like-kind investment real estate. It doesn't work for moving real estate equity into debt. That's not like kind. Debt is different than equity, right? They're completely separate. So you need to use a debt strategy. We found the one being an installment sale, but you couple that with a trust. We call it a deferred sales trust that allows you to exit the assets, defer the tax, and then turn around and invest it into any asset of any kind at any time. In fact, we just did, for example, a $13 million exit in San Diego for some clients who really felt like the market was turning. And this one's about 2 years ago. And they used the deferred sales trust to not only exit, pay off their debt, but they put the majority into a debt fund, very similar to yours, all tax deferred, and they deferred the tax. And so this trust is formed, and they exchange and they sell their asset. Instead of exchanging it into a qualified intermediary, they actually sell it to the trust and they get a promissory note back. It's known as seller carryback. And they have it's typically structured at 6 to 8 to 9%. But from there, the funds can go into any investment. It can go into T-bills, it can go into real estate, passive or active, it can go into development projects, go into business ventures. But the number one we've really loved is debt funds like yours, because of the security we believe with real estate still being the foundation, but being that first position in case things go south. So it's called a deferred sales trust. Any thoughts or questions on that so far?
Gosh, you definitely caught my interest here because this sounds amazing. I'm going to definitely research this more after, and I'm sure we're going to have some conversations after this recording here. But no, I don't necessarily have any questions other than you said sell it to a trust. So I guess you transfer ownership into the trust, and the trust signs a promissory note, it makes payments, and then to actually free up the cash to make the investment into the debt fund, I guess you would have to sell the asset out of the trust.
You got it. Yeah. So it's three parties, right? So in a traditional installment sale, there's two parties where you're just financing the buyer. But then the challenge is all of the equity is tied to the old asset, which defeats the purpose, right? So we take the foundation of a seller carryback and we say, hey, go find a buyer. Like we just did another, in fact, Friday it closed, right? It was a $2.2 million exit in North Dakota. Okay. And they're selling a farm. They have basically next to zero basis. And so instead of no debt, and so instead of financing the buyer came with the 2.2 million of cash. The trust was right in between. The seller first sells to the trust on an installment. Okay. Over here, actually. And that installment is a $2.2 million promissory note. Right. And then the trust immediately sells it to the buyer. So the cash gets infused into the trust. And so the trust bought it for 2.2, sold it for 2.2. So there's no gain, right? And so that's good. The buyer takes title, they're gone, and the seller's left with the promissory note. But now the funds are sitting in a liquid, typically Charles Schwab, and now it can be diversified dollar cost averaged, right? There's no timing restriction, no 45-day 180 shotgun wedding, no like-kind replacement requirement, or even worse in the 1031 exchange, the equal or greater debt replacement requirement. Right? That's where people really get hurt because they have cash flow, tax flow, and debt flow, and it gets all out of whack. They end up doubling down on their debt and or going more by interest rate. I mean, on that, maybe the same amount of debt, but higher interest rate, inversed cap rates to equity or to debt. In other words, the debt interest rate is higher than the interest rate. That's not good, or the cap rate. That's not good. You want the opposite to happen. And so this solves all of those challenges. You can get your debt flow, your tax flow, and your cash flow all aligned. And when you do that, you get time to be your friend, right? Versus your enemy, and you get diversification and liquidity to be your friend. Again, you can learn more about it by going to capitalgainstaxsolutions.com. Any thoughts or questions on that, Kevin?
No, I think it's a genius. I don't know how I haven't come across this. I've been doing real estate investing for over 20 years and haven't come across this. So super fascinated.